Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for April 14th, 2022. Sorry about that on the first feed. Forgot to hit my audio, so here I am talking to myself for a few minutes. I was really just getting into that and starting us off with the idea that, first off, happy holiday weekend, everybody. Should be interesting to see how we open and reopen after this long weekend. Tomorrow, Good Friday, is in fact a market holiday. So we don't have the markets open. Nothing will trade again until Tuesday or Sunday night here in the United States futures markets. But we do have a banking day tomorrow. So margin calls do need to be met. And what that means is that if you went home on a day one call today or a margin call today at all, it would progress another day on Friday and be a day two minimally coming on Sunday night. So that means that the idea of forced liquidations and when margin calls exist, they oftentimes cause and force people's hands to be to make a move, and that's either by putting up more capital to meet the call or getting out of a position. And so into early next week, because we saw markets like corn, for example, kind of close up and at near highs going into a long weekend. If we see a gap up on Monday, or Sunday night, it's very likely going to result in a big stop slide and liquidations higher, which is that hair on fire buying that you see in marketplaces like this sometimes. Now, the other side of that coin could be that we reverse hard from today's highs and gap lower and what have you. But the fundamental picture that's being painted and the narrative we've been discussing for the last several weeks has been a bullish one in nature. So with all that being said, remember, trading in futures involves risk and is not suitable for all investors. And everything I talk about here today, just my own opinion, not a direct trade recommendation. But if you are interested in turning those into trade recs and doing more with your marketing plan, or trying to be more on top of your trading, give us a call over here at Zaner. I'm always available to talk with you about that plan, the risk that you might be finding yourself into, and how we can best manage it and going forward. So let's begin today. Actually, let's begin with corn. May corn's a great place to start. Those daily technicals, we're starting to break away from and break out of. This is very reminiscent, this kind of consolidation and breakout we're having here at the end of March into early April. Very reminiscent of some of that, start of year price action. We held above 100-day moving averages, held above trendline support. We flirted with that 18-day moving average until eventually found support, started to trend higher, and then started broadening, the rally higher. Today, to me, suggests that we are now pushing through that threshold and the resistance we had found in the marketplace. We're now heading for a solid test of $8 here in old crop. Even though we're hitting overbought conditions here on the daily RSI, I see no reason to start picking a top in this market, not given the high fertilizer costs we're seeing and how that could play forward in the marketplace. Now, fertilizer costs, you might say, well, Dan, that's kind of a negative on price here. In other words, we may not want to put as much corn in the ground because of that risk, right? Well, many of you have already, and many producers, for those that are not, have already made the decisions on how that acreage is going to go this year. And any kind of input costs, right, have very likely been locked in, or you've already searched around or you're in the very last minute process of getting that if you need it already. But many people have already taken that into account. Where this is a problem for, and we've talked about in the past, is the fertilizer costs are a bigger problem in South America, mainly because they don't have their own means to source and produce it. 95% of that value-added fertilizer is imported. And if countries like Russia and China are exiting from that export market of fertilizer, countries like the United States are only going to be able to afford, and Canada only going to be able to afford to produce what we need here and use it domestically. Those added global acres, in other words, the acreage that has been added to the industrial complex over the last 20 years, that's all gone. Africa, South America, much of Asia's acreage, places where you can't grow a crop because you don't have that soil that we do in the United States, or a good dirt belt like you do in Ukraine and U.S. and a few other very, very few other places in the world. You're not going to see production on a global scale for corn that we saw last year and this year. This might very well be, if the current trend continues in the fertilizer market. Analysts who are much more familiar with the situation than I am are saying that we will not have a corn crop in South America at all. because there's just no way to grow corn without that fertilizer. And have it produced, right? It's going to be a plant. It'll go in the ground. It's not going to die, but you're not going to get a fruit from it, right? You're not going to get the plant trying to thrive and produce offspring and go into its fruiting stage when it's just trying to use that nutrients just to survive. All right. Anyway, that's the story on why corn is, I think, turning exceedingly more bullish. Crude oil prices going up, the ethanol talks and mandates going up globally over ethanol usage, starting hopefully here with the Biden administration and their talks earlier this week on trying to get those blending mandates ramped up to either be, all year round type of events or expanding them. That's all great. We want to hear that. I think that is a win for everybody across the board. It's a win for our farming producers. It's a win for our any consumer at the pump. And arguably, it could be a win for the Biden administration, which they really need at this point on the energy front. Strategic oil reserve releases have not done anything to quell the rally so far. In fact, I have argued that releasing oil reserves is one of the worst things you can do to try to quell oil prices, because all you do is cause short-term volatility, a very short-term dip, allow producers to buy oil, those that are cracking and producing gasoline, to buy oil at a cheap price at a discount in the near term. But then that strategic reserve is going to need to be replenished. And the only way to do that is to buy more oil and replenish it. So you shock the market by selling it off, but then the market absorbs that shock, turns it into the end product. Now you're left with less commodity, and you're forced to buy more of that commodity when there's less of it present in the world. Economics 101. You're creating and feeding into your own price rationing of demand when you release strategic oil reserves. And that's assuming that you're going to replenish them. And I think it'd be idiotic for any country to sell off the reserves and not have a plan to replenish them, because if war or actual strife or something broke out, those reserves are meant to be an insurance policy in those situations. And now you don't have as much of it. So if the U.S. was to go to war today, lucky for us, we are, an oil exporter, and we produce more than enough and have more reserves in the ground that we can untap very quickly thanks to modern technologies. But using our strategic commodity reserves as economic means for economic means is not what they were intended for. What can you do? And it's a good reason we're seeing inflation do what it's doing. All right, enough on that front. 18-day moving average here, 756 on the corn. That's going to rise up here. We're now above the trend lines against the highs and against that kind of figure around the 775 area. $8 to the upside is, your next logical target, right? And big round number. But I honestly, I'm in the camp that I think we're going to, $10 corn at some point. We've looked at this in the past, and I think it makes sense to continue to look at it. May corn last year, this rally that occurred was at the end of April. And I would say that we are right, getting to be right around here on this chart, right? Mid-April. We still got lots of more price action to the upside if this market wants to continue. The rally here began around the 570 figure in May corn. It did not end last year until the 770 figure. That's a $2 rally between now and mid-June. Now in mid-May, a month from now. Where we started to find, the market was trying to top out at that point. There was still one more push higher in June to really cap us out. But moral of the story is over the next 30 days, if we follow the same type of price action we saw last year, this year's market is just getting going still. And we were talking, I think, last week about using the $7.88 calls as a strike to own. Selling something above, $9 perhaps, anything to bring in a little premium. But I see at this point now that we've broken out of it, I'd like to buy a dip and a pullback. I'm not so certain it's going to happen. It is unfortunate we're having a strategy of the day where there isn't as much strategy to do, as much chart price action to talk about, because the moves have started to happen out of the range. And now I do think we are getting closer to a top than we ever have been before. But I'm certainly not one to start selling, right, and start trying to pick a top here. It's still a bull market. Hop in on the uptrend while we can. We have tightening carryouts. Acreage numbers are going to be an argument until we get our insurance numbers back, which last year, if you remember, came back very quickly. So I think we might see that turn around pretty quick here this year as well, because I think there's now more than ever has there been a need to really know what acres are being planted so that we don't have as much unknown going out through the rest of the year. Weather events and the geopolitics aside, those are enough to keep this market building, I think, risk premium. If you don't want to call it weather premium, call it risk premium into the marketplace, because you have buyers and the demand side, which is afraid. There's very real reason to be afraid for future production. If not, by November, by this time next year, we might be singing a very different tune about the Ukraine, about China, about South American production, all for their own different reasons that this time of year are turning the charts a little more bullish, aren't they? So on the short time frame today, actually December corn did not finish their positive on the day, down a half a penny, but December corn, new crop corn, has been in a bull trend now for the last 3 weeks. I do think new crop corn is starting to find a top, but I'm not so certain we're going to see as much selling in new crop as we would just see the bull market, return to the old crop contracts here. So the spread is currently sitting at around 60 cents. I've got it up here on a chart. We'll take a look at it here in a minute. 49 cents over right now in that July. Oh, it's because I'm looking at May here, of course. May being at a slight premium to that July. 7 cents to be exact. The 50 cent over here that July no beans is trading. If we're going to see this rally to $10 beans, that spread is very likely going to become a dollar or $2 wide spread. So 50 cents more higher on the July D spread, $2 higher on outright corn, makes sense to me. In this environment, you get a 2-to-1, kind of movement, and that means that December corn is going to, either go down by a penny on days that July corn is going to go up 2, or only go up a penny, or go down by a penny on a day when July corn goes up a penny. And that's much, the type of price action we saw here today. And I would continue to look for that to happen here going forward. Sorry, I should have brought this spread chart up. I'm a little out of it here. The last 2 weeks have been chaotic in a good way. Obviously, welcoming a new member to our family here. The third member to our family has been an exciting adventure. And man, it's like the market knows when you're just slightly distracted, doesn't it? But at least over the last couple of weeks, we've been looking for this type of development to occur. Now it's starting to come to fruition. If you haven't jumped in on these things, it's still not too late, right? There's still plenty of room to the upside here. If we're going to go back to contract highs in July, D's corn, there's still plenty of upside in the outright contracts. But I will admit, from a production standpoint, we are getting close to the point where we'll start to think about wanting to put on some mid-season hedging. If we're not sold yet, we are within pennies at this point, and both pennies and time, in my opinion, for wanting to start to make sure we get hedging taken care of and not just the reownership, which ultimately the trend has dictated up until now. So July D's corn trading at 48 cents over. It's been a bit of a range here, and the range for the month has been trapped in this 20-cent period. I do think this is the push that we get above trend line here. We're now already above the old highs of the week. Get back to highs of the month. There's not much that stops you for a retest back towards 70 cents over. Don't think it's going to go straight up from there. There's going to be some up and down. Last time, it pops up here, there's a pullback before it continues and trends higher. We're going to look for that same type of price action. But I think we are starting now, the last 2 days of bull spreading we've seen on this chart, I think that's the start of the bull trend resuming. The canary in the coal mine of old crop, new crop spreads in the calendars is, trying or starting to confirm that somewhat. And now it's going to be important to continue to watch those outright markets, the what are they called? The outright futures, for more clarity. May corn today on the 4-hour time frame. We had a supportive area here down around 715. We were talking about, is equal legs down if you measured this first kind of leg and extended it from this second leg up. I see this as a down in 3 legs, 1, 2, 3 down in A, some choppy B wave, and then kind of C leg down to complete an A, B, C structure down into this 50% fib drawn from the 655 gap or that swing low to the highs. We held that 50% support. We held trend line support here against the lows. finding new trend line support here and started holding 50 backs in pretty much every time frame that you could draw them, with the exception of this one little dip below a 50 back here, or what I refer to as an ambush long there that happened at 740. They occur when you break through the opposing side. Let me get rid of some of these fibs and we can just walk through it here real quickly. It takes 2 seconds to draw them back up and to give everybody the same clarity and vision I have. So, you might have been thinking about being a seller, right, on this leg down. Let's just imagine none of this price action to the right has occurred. And so you're staring at a chart for corn that looks like this, and oh boy, we just went down to 715. Maybe we think about being a seller in a rally. Maybe we're going down to $7 and below. That's all perfectly normal thought-provoking ideas at this time on a chart, right? Then the market starts to bounce a little bit. Okay, we're coming up. So if we're going to be a seller, where would we want to do it? Well, 50% short from the highs, whether you draw it from here to the low or that swing high to low. You can see how the market kind of spiked up right into that 50% 618 line, got a reaction initially, but then the opposing side came in and held here. So when I say it got a reaction initially, if you look here, we actually went right and tagged the 618 line. So breaking one 618 line and then the other 618 line kind of resets things, in my opinion. It's a way of the market saying no one's in a clear control, right? Neither side's holding the 50% level they want to hold. Shorts kind of got up to the level they might have stops and it got hit. Then the longs got their kind of stops hit. Well, once that happens, that's fine. It's kind of a reset. Well, then you still continue to look to see what side might start picking up the trend. And then, the pullback then from that 748.75 high down into, the low of that afternoon session there, well, that was a 50% long from lows to highs. And wouldn't you know it, if you play that tape forward, the market actually spiked up to its target area. And so by doing that and then really taking out whatever kind of fibbed short was drawn, now we might have a bull trend taking over. And, to that point, you start drawing up those fibs. You start drawing up now the next in the series from entry lows to the where that target swing high was. The market took 2 steps forward, 1 step back, 2 steps forward, 1 step back into the 50% area. Trend line supports holding. You had a couple days of consolidation, but that 750 area held. It was also, kind of the area that we were holding below there for a couple days. Held it and then traded up into a new high. It was at that point, when we traded from this 750 area up to 775, where the bulls really started to take over, because that cleared them through this cluster of old highs and really put the old highs of the month and last month, I should say, as the next striking point. We consolidated then for 2.5 days here against trend line. And if you draw the next in the series fib from entry low to this target highs, when you know it, we did another little 2 steps forward, 1 step back, 50% levels held, and the market is now traded up into its target area. So still swing from low to high here. Next little 50 back. Watch that 780 area, 777 as support. Trend line's there. Next 50 back is there. Cannot deny, though, that a full 50% retracement from this swing low to the new highs here, down around 750, would be a big level that I would be a buyer at if corn gets down there. That's where I'd maybe start buying the $8, $9 call spread. When we're a little higher like this, I might only buy 10-cent dips off the high, using 5-6 cents of risk, but trying to catch maybe that 20 or 30 cent upside swing. Because if you're buying a future at these levels, there's no sense in risking more than just a few pennies. Because if the market turns over, you're probably, one, going to have a better opportunity to buy it at a lower price, and two, we are at a time in the market where a seasonal top does tend to try to form, and we're at prices where those tops historically have been over the last several years. Okay, and actually above them. So May corn still looking for it to continue higher. The strong close we had today above last month's high. There's a strong probability that I think corn will gap higher on the open next week. And if it does, it could be one of those moves that gaps like above $8, and then we have an open gap at $8 while we're running higher. Not type of price action I would at all be surprised to see. I also wouldn't be surprised to see it gap up and reverse back down to 750, just because that's what corn likes to do, make a new contract high on a weekly, monthly, all these time frames together, and then burn all the buyers for the last 24 hours, set off some margin calls. Then a couple days later, once those margin calls would have aged out of the market, the market resumes its uptrend, leaving all of those longs that just blasted out of luck. And we see this a lot in futures because they, in my opinion, are designed to cause the most pain. But being aware of that, of how they try to trick and trade people, is part of the game too. So, very bullish still. Lots of open gaps below us. High probability with a long weekend here of a gap higher. We'll see what happens. I've been talking for 20 minutes now, and we have not even gotten off corn, which isn't a bad thing. I want to flip over to oil real quick and take a look at the crude. That 50% area around 96, holding valiantly. That's just a 50 swing from this like 60 area up to highs. Crude did 2 steps forward, did a step back. Equal legs down, still down around 80. If it got down there, there's larger trend line. There's larger full 50% levels. If we go out to a daily level, you can see the full 50 back would be around 68 if crude did a huge pullback. But holding where we are now and kind of doing this pennant flag and breaking out of this, heading higher, now upside targets are towards 146 and would extend towards 172. That would take crude to levels that I think could surely encourage some commercial selling if we're not seeing it already. But it is interesting to note that crude did go down, tag that 92 low, 93 low, I should say, go right below it, made a new low beyond the prior month before reversing higher. Crude, with that type of price action, it doesn't make me necessarily want to rush in here and believe we're going to a new, contract highs, but a move back up in the range we've been in, which can just simply be defined by the 116.50 highs down towards the 93.50 lows there. Shopping around inside of this range, I don't think is out of the question. And having broken through this trend line, generally speaking, that is kind of one of those first things I would look for to start suggest, okay, now crude's in an uptrend up towards 115. And if we dial down to the 1 hour, the 4 hour charts, you can see it's a pretty good strong uptrend off the lows. You're going to have now trend line support going, helping the market out here, coupled with, clearly some measurements or some pullbacks occurring in the short term. But generally speaking, crude's reversal here over the last couple of days, I think it's more than just short covering. I think it is the resumption of the next uptrend because inflation is proving itself here to stay. All right, let's get into soybeans here. May soybeans closing the day 1682 quarter, a positive finish on the day, and honestly, a very positive close for the week when you consider how far we've come, where we were earlier this month, how we spent the last 2 weeks basically trading from a low of April right at the start of trading, and have spent the last 2 weeks trading higher back to test $17. Old trend line resistance here now, or support now is resistance. Certainly a reason to think about, the warning signs. If the market doesn't continue through, we might have reason to believe we could turn lower. But otherwise, there's this trend line against the high that I'm more concerned with, which really is just now banging up against the $17 figure. And kind of like soybeans or corn, if we gap up above these figures and continue to run, they make for really good gap and go levels. It's almost impossible to trade that because a gap up also has the high probability of filling and reversing off of that gap higher, and that could hurt you a bit. 100-day moving average down around 114.97. The 55-day moving average at $16 came in as support. It was also our old lows and a gap fill there at around 15.81. 80-day moving average, we finally broke above it here a few days ago. Came back down to test it as support, have been holding as support for a couple days, and now we're trying to, take this little bit of a bull flag and pennant we have for the last couple days a little higher. Watch that 55-day moving average around 1630, 1640. If we get down there, it's a 50 back. There's a good reason to think the market could hold, support from there and continue higher like it did before. But if we do head down again, there's not much in the way of stopping us from getting back down to $16. This is a pretty clear range-bound market we've had, and if this is some kind of triangle, A, B, C, and D of the triangle have formed, we'd expect one more pullback at E, which is usually the best time to position on a triangle before the breakout higher. Sure, that's all good and fine, but it's going to be really tough, I think, really tough for the beans to sustain their rally here without corn going bonkers or justification on a cutback on acreage. And I just say that because the soybeans of all of our crops have the least chance of not being put in the ground this year. In fact, you're almost encouraged, I think, to try to put. I might put soybeans in my backyard here if I can get $18 a bushel. I don't think I could even get 1 bushel out of my backyard, but jokes aside, every acre I think that you could, you'll throw that in because why not? So long as it's not going to just die on you. But to that point, your corn acres are also going to be accounted for and paid for at this point. All right, so soybean demand has come under a little scrutiny in the last several weeks, mainly because of the backup we're seeing in Chinese ports. But we saw some flash sales here again today. So, rounding out their old crop numbers is an impressive thing out of China. And we would like to continue to see those sales going forward. Higher highs and higher lows today. Kind of like corn had a bull flag on that daily time frame. Soybeans have one down here on the intraday time frame. Trendline supports around 1670 at this time. Intraday, I think we are banging up against a trend line, kind of two trend line resistances in that $17 figure I've talked about that we should, I think, continue through. 1640 is my supportive area. As of yesterday, as we were heading down there and we started to sell off after the bell, I thought we were going to go down there. That would have been a nice 50 back into this 50% retracement for the soybeans to have held. Obviously, market didn't get there. Still 3 waves down occurred on that first day, and a failure to break below that prior day's low here, I guess, was the reason we saw the short covering. Can't rule out one more leg down to that 1650 to 1640 area. Again, I might be a buyer if it gets down there based off of the triangle and everything else we said, but when we're sitting here looking, watching, waiting, wishing, wanting, usually this is where it doesn't happen, and this market's just going to go if it's going to go. But we do start to slip down and back below that 1640 area. There's not much that would keep us from getting back down to 1580, kind of like on corn, down to 750 if we start to slip. And likewise, if we go below that trend line, hard for us not to get down to 640 to 650, just based off the ranges we've been trading in as of late. Upside targets, $18.30 to $19 is not out of the question here for May soybeans. Again, let's take a look at that daily time frame. That trend line against the highs that hopefully will break out and bust out. But May 21 beans, there we go, through April 12th, we're quite sideways, right around the $14 handle. It was arguably wanting to break out of $14.50, $15 at the time. Excuse me. 100-day moving averages and 18-day moving averages had gotten a little, or 55-day, had gotten a little compressed there. But generally speaking, the last couple months from February through April were dictated by this range between 1350 and 1450. Then April, mid-April came around. We had Easter weekend. You had late WASD report, if I remember correctly. Anyway, lost my train of thought there. But moral of the story is another $2 rally higher. In this case, we rallied from about $14 all the way up to about $16. So if that same idea takes over from here, we're talking $19 beans by end of May, and we could in essence be setting ourselves up for a true test of $20. Corn being at 10 and beans at 20. We've talked about this before. They've been trading at those prices in mainland China, so the global market's already ready for it. It's just a matter of arbitraging that price out all the way here to the U.S. So pretty explosive rally here in the beans we saw last year. If this year's going to follow suit, I think we welcome it with open hands at this point. Going down to the smaller time frame here in intraday. The close here right at yesterday's high was definitely the market trying to stay above yesterday's high. And I think closing above 16, that high would have been, sparked a little bit more of the bull side there into the day. But this market tried valiantly to not break out. it's been trying to stay below $17, and we've been failing for some time now. I really do think um, it's time we moved into looking at some options here together, as I believe it makes sense to start looking at that $17 strike if you haven't already. Giving you guys some ideas into next week. Obviously, we can't act on these until next week. Hopefully, the market doesn't blow away from us. Kind of stinks about this strategy of the week. We don't have anything to do now for a while. But I do want to look at some of those weekly options here. Okay. May soybean. We don't care about the May, but we'll start there. Okay. So $17 calls here, 11 cents. I mean, if you were to grab those going out the day there at 11, I think that was probably. I mean, there's only 8 days left on these. These May options trading like weekly options, but I think that $17 strike for 11 cents to me made a lot of sense on a risk reward perspective for the day. One, you're only taking 11 cents to risk on something that's 20 cents out of the money. So you need a 30-cent swing in the beans, which has been the average daily move, has been at least that. So in a week's time, it's definitely achievable that if we see the same type of price action over the last couple of weeks, we could be at 1740 or 1760 by the time this option goes off. However, it doesn't give us much time. And now that there's nothing to do or act on it until next week, what can you do? So instead, let's try to position something out. I think you're going to have to go out to the July timeframe here. Maybe look at June on July. But last week, forget what we looked at last week. I know we looked at call spreads. I've just been too bullish this market, almost to a fault, it feels like. But it's years like this where you look at the balance sheets and you look at the bigger picture, and it's really hard to see how prices are going to come down before June and July, and before we can confirm we have a really good year production wise. And even then, it may not be enough. $17 calls here through July with 71 days on it, 53 cents. Now, granted, they're a little further out of the money. We went out the day there at 1665. That is really costly. But the market's clearly pricing now the ability to go in there. So that's an option that's 35 cents above the money, going for 53 cents. 35 cents below the money would be the 1630 put, 44 and 3/4 cents. There's a 10-cent difference between those two strikes that are effectively the same distance from the market. That's amazing. The delta on them slightly skewed too. Look, the delta premium here is at 0.38 versus 0.44. Makes a little sense because of the green, nature of the close and the rally we saw, from the lows of the day to put that skew to the call side. But the market is clearly driving that premium or demanding that premium here, and is a little bullish. It's risking. It says that market makers say they need to take more risk on the market going higher than it does going lower. $17 calls for 53 cents, 35 cents out of the money. Again, very obtainable, but you'd have to get to 1750 basically to contract highs for that to even be profitable for you at this point. But we can dramatically cut down on that cost here. 1820 calls going for 23 cents. That cuts us down to a 30-cent cost for a $1.20 wide spread. Not bad, but not ideal, but not bad. Not bad. You'd take it at this point in the game when we've rallied up as much as we have. That spread, a couple days ago, when we were down below 1640, you wouldn't have wanted to pay more than 20 cents for. But things have changed now that we are 50 cents higher, and justifiably so. It might make sense, though, if we're going to be going higher, 71 days, I think we have the ability to get to $18 to $20, right? So an $18 call is going for 28 cents, and I mean, selling a $20 call and bringing in 7 cents kind of seems silly, but it also cuts down on your cost there to 20 cents for a, um, less than 20 cents actually, right? 19 cents for a $2 wide call spread um, that has 71 days on it. I think that is an interesting trade, mainly because even if we gap up above $17 on Sunday night, the cost of that spread will not be that dramatically different than where we are right now. You'll maybe pay 5 cents more. Um, and that's okay. I think paying 25 cents, maybe even 30 cents for that 20 cent wide, $22 wide spread will pay off this year. Obviously, the moral here, or what we're going to try to do is you want to try to buy it as cheaply as possible. So, not the type of environment where I love selling calls, but so long as we own a call against it, great. We will start to talk about some of these strikes and how to utilize, and maybe we mention it right now because there's not really much to do right now in this market. I will probably be doing a video on Sunday night or Monday early morning to recap where the market's been to provide more actual trading ideas then, because right now there's not much to do before this weekend. For our producers in the crowd, these are great prices. We're going to want to start talking about locking them in. Well, going out to November, and I wouldn't do this just yet, but at some point, right? November trading at 1504, $18. Well, let's go to $20. Actually, I can't even get the strike up, but I think we could imagine a $20 call probably going for 8 cents, bringing in 8 cents. That's $5 out of the money. 8 cents is not a lot to bring in, but that is the type of strike and the type of thought process that I'm starting to put on paper to think through, so that if we do rally $1, $2 higher into mid-June, we've got good long positions on. If we've structured our re-ownership strategy right, we really need to think about now being sellers in a real way, buying puts, selling futures, maybe even doing cash sales, and not doing re-ownership, because we did the re-ownership as a pre-spreading type of idea, hopefully. Now when it comes time to actually cash in on the pricing that we want come mid-June, we need to have the plan now to say when we get there, we're going to do it. Because far too often I'll be making phone calls on that day, and we'll want that 5 extra cents higher, maybe 10 cents more, and I can't tell you how many times I've watched the regret come over the phone by not having the plan in place to get ready to sell into $18 through $20 soybeans, into $8 through $10 corn. And I'm not talking necessarily old crop pricing or new crop pricing there. That's more where the old crop is. But have a plan over the next month or two into June to make sure you get sales and lock in hedging on the board, because that volatility will be some of the best volatility to play going into that harvest. Hopefully then we find a harvest low and we start re-ownership or curbing that strategy back the other way. It's following a very similar pattern and price structure as we did last year. The fundamentals, with the exception of Putin and his war in Ukraine being another more fuel on the fire, everything's very similar to last year, but maybe even more intense. Like last year, we're starting off here with pretty dry conditions that, if we don't see participation come, are going to continue through and into next year. Today has been a little bit of a hodgepodge. I apologize for jumping all over the place a little bit here, but I'm trying to cover as much as we can in what I was thinking through today, because today is one of those days where we end up digesting a lot of information rather than acting on it, and those days need to happen in trading as well. Corn. December corn, $7.35. I think all of us would like to start sinking our teeth in above $8. If there's a way to lock that in, we're going to want it. To the upside here, though, $8 December corn, not a bad place to think about being a buyer and having some re-ownership on. But look at this, 56 cents. Granted, it's 225 days away, but you got to get to $8.50 corn to even start seeing a return on that investment. That's a $1.20 rally from here to even see a penny back. You need to rally a half a cent a day between now and December to get there. That's crazy. That's some crazy premium they're demanding. Again, why we look to call spreads. because we can cut down on that dramatically by selling $10 calls here. For 21 cents. 30 cents, $8, $10 call spread in December corn. If you haven't gotten that position on yet, that's one of my new favorites. Kind of just discovered it today. I don't know why. Well, we weren't high enough yet. I didn't want to start. Well, I don't know what I'm saying there. We wanted to make sure we were getting the confirmation of this rally first. There we go. But I will say this, if we're only expecting old crop, and again, a reason we might want to keep these trades in the old crop versus new crop, we're expecting old crop to rally $1 or $2 in this same time frame. Well, granted, this is December, so be further out. That gives you good reownership to start. However, that $10 call, again, in December corn, take away the $8 reownership. We can sell $10 corn for December for 21 cents right now. Put in a profit objective on the chart. I like that idea a lot, and we're going to start working with clients to find a way to sell that $10 call for you. And in doing so, you're going to have some margin you have to put up. But we can try to cut down on that risk by then turning around and looking at the July on December. And what is an $8 call cost there? Perfect. 19.5 cents for the $8 call. Okay. Do you guys see what I'm doing here? Yeah. By selling the $10 December call and bringing in 21 cents and buying the $8 June on December call for 19.5 cents at a penny credit to you, covering some of the costs and commissions and everything else on the trade. So let's just call it all, at the end of the day, a very small penny cost of any commission you might have. You get an $8, $10 gamma spread on the market where you have reownership at a cost of 19 cents at $8 December corn between now and July. If we see the rally, you're covered. If it continues higher, you don't have to worry about that short $10 call anymore because you've got an $8 futures in December corn on your board. The $10 call then ends up becoming your, profit objective. You do nothing with it. You keep it. Maybe you buy it back if it actually goes worthless. But the truth of the matter is that we're hoping for corn to go to $10 and to get called away there. And if we do, we're your board price, your board position is taken care of. You're taking $2 off the out of the futures market there for yourself, and that just allows you to concentrate on marketing your physical grain. If between now and July we don't get that rally, well, at least you paid for any kind of reownership at virtually no cost between now and then. Over the next couple of weeks, we will be putting together plans for how to now bring that floor up for you. So now we're trying to create, I don't want to say create a ceiling. That's the wrong objective with the price strategy I just mentioned of $8 July on December call and selling the $10 call as a spread. The $8 call could very well expire worthless, and you're left with the short $10 call, which then if it rallies between now and then, and you do get called away and short at $10, well, at least we can say that that was probably one of the better sales you may have had for the year. But there's plenty of time between July and December to put on a board long in a futures, an option, whatever, to offset that risk. And actually come July, if that July call is no longer working for us, we would very likely look to spend maybe 5-10 cents on a 950, 990 call, something to offset the risk on the short call if we do for some reason rally there. But more than likely, if we're heading lower and that $8 call goes worthless into its expiration, that $10 call that we sold for December corn, it's going to probably be pretty worthless too, and we can buy it back without much minimize the risk on the table. Like I said, this is putting a profit objective in the market and doing so at a with a cost effective strategy for you, and having some short-term reownership, because the idea is that that $8 call, if we do go up between now and July, its gamma, or it's going to be, excuse me, its delta is going to appreciate faster than the delta of the $10 call, giving you a net positive delta in your favor, hence the gamma. I believe that's gamma difference there. In the event over the next couple of weeks that we do see that downside, we will begin the discussion, or maybe even more upside. No matter what, over the next 3-4 weeks, we're going to start a discussion of how to put a floor in the market and start using some put protection. Put spreads to start, owning outright puts, maybe even selling some ahead of the rally to then with plans to buy back. There's a few different ways to skin that cat that we'll look at going forward, but moral of the story is, and the elevator pitch from everything we talked about here today, call spreads are still where it's at. I don't think we've left the ship. I think we do have a small opportunity on Monday, Tuesday, Wednesday next week, maybe to position before this rally. And if it does take off like I'm expecting through May to June for us to find a very strong market, market price action continue higher, and then after that, taper back, consolidate a bit, and ideally find a downtrend into that harvest low type time frame where we can re-begin the whole discussion, because at that point we'll have a very clear understanding of where production is going to come out. We'll get a good idea of how much we can rely on the potential production out of South America, because at that time in the equation we'll be talking about how their fertilizer issues have compounded or haven't, the rest is history. So not much to go on in the beans today. Sideways price action, slightly higher, looks good. I think we're starting to try to break out of something. Corn showing the follow through, and then one quick look at wheat here before we take off. And I got to go do a 3 o'clock feeding. I was almost going to introduce the little guy here today, but he's napping. So again, for wheat, 50% retracement. We took 2 massive steps up from $6 to $13. We did one big pullback to $10. 2 steps forward, 1 step back. 50% short off the high, comes in around $11.96. I think we could get to $12 just for a nice good old test of the figure. But this does look like the start of a little bit of an uptrend. If we do roll over, though, you can't argue that wheat's definitely in a range here. But the market did pull back to test that Ukrainian crisis breakout level right around $9.50 to $10. So if it holds here, I do think it has every ability to base and continue higher. We're going to continue to watch trend lines against the lows here. They, kind of right around a 50% line if it comes. And of course, I alluded to it just there, 50% from 972 to the highs above 1050 is an interesting level to watch. In the near term, however, I think there is a more aggressive little series of price action happening here that's kind of hard to dial in on the 4-hour chart. But if we go down to the 15-minute chart, there's a gap up here that the market, I think, is using as some form of an anchor that you see same anchor, new high once, twice, and this could be the 3rd time on this, a test of 1190. Market would then push up to 1140, 1175 from there. We'll see. I think there's a lot of unknowns with wheat, but I do think we've hit the point. I think on April 1st, in my opinion, we hit the moment where it became too late for Russian and Ukrainian wheat expectations. Now that I think we've gone beyond that point, I think we're into a point of no return now for production out of Europe for wheat. So I think that 1/3 of the market needs to be discounted, or 1/3 of production globally needs to get discounted. Not for this year, because everything that's in the bins and such, that'll get sold, right? Russia may not be able to put it on a ship and send it to an end destination, but put it this way. In the 70s, when there was a similar embargo on Russian wheat, Germany overnight somehow became the world's biggest wheat trader. Don't know where all that wheat came from, but it sure wasn't from German fields. So you're going to see other nations like Belarus and places try to launder that grain out and away and around sanctions. And believe you me, Russia will find a way to sell it to a counterparty, whether it's directly to China or vis-a-vis the rest of the world through India, there definitely looks to be because remember, conspiracy theory hat on for a second. Not really conspiracy theory, but India is already talking about a surplus of grain this year. What a perfect place for Russia to be able to sell theirs and arbitrage it through. A country that is producing more wheat this year than they ever had before. Suddenly, maybe a few more bushels get found in that record production. Not, I think, to the tune of all of Russia's, but obviously already willing to do deals over oil, both China, India, and other nations. What would stop them from wheat, right? But that doesn't change the fact that the rest of Europe and other allied partners would be not buying that source of agricultural product. And to be fair, in these times of crisis and what have you, it seems like oil, food stuff, and these real hard commodities, nobody can get enough of them because we're all afraid of where they may be. And wheat and corn will be your two big breadwinners, pun intended, for that idea. So definitely continuing higher highs and higher lows here intraday for wheat. I wouldn't be surprised to see a little volatility on Monday, but generally speaking, still looks constructive. It does look like 3 waves up, though, so I am worried that this is all part of a larger correction and that the blow-off top for wheat already occurred. But as long as we're staying above $10 psychologically, higher highs and higher lows continue to form, and we continue to hold trend lines. There's no reason to think that wheat can't resume its uptrend. It's just a pretty crazy market to trade. I think it's a little safer to concentrate on the corn and the beans this year, given the situation, given their lack of connection to a global conflict right now. So that's about it for me today, guys. Thanks for tuning in. My apologies, we didn't have much more in the way of ideas today. It's kind of a showcase of just some technicals and talking through some of the ideas that we're going to continue to want to monitor and look for. We're into the fundamental time of the year again. So the technicals are what they are. We saw where trend lines are. We saw where moving averages were. We saw where old highs are that we need to break out of. All the things we need technically to happen. We have the fundamental picture. We have the other developments occurring. So let's see if the timing is right now going into our planting season. Have a great day, everybody. Have a happy Easter, Passover weekend, relaxing, enjoy your holiday, whatever you're celebrating or not. I think tomorrow's going to be a welcome day off. It is a banking holiday, so if you do have a margin call, do try to meet that margin call, and if it makes sense with funds, because you will be one day behind come Monday, and for any broker or FCM, that is only going to get them breathing down your neck and trying to either get you liquidated or margin excess in some capacity, which means by Tuesday, Wednesday, we hit day 3 and 4 for absolutely everyone in the market. Would be, any margin call that went off today would absolutely be at the point where they need to be liquidated, and that can be or at that point, usually we talk about forced liquidation and not meeting it with either market price action, market appreciation, or funds, because why wouldn't you have funded it already? Moral of the story there is that that's typically the day. You can almost count the number of days from when, up to 3 or 4 from when a market extreme occurs, when the market might then finally start to recede because it's done squeezing the side that has now been blown out of the equation. So hard to find a chart that doesn't look too bullish right now, with the exception of the Treasury note futures, and I am talking the futures and commodity space. So we'll see if that continues. Have a great day, everybody. Have a great weekend. I can always be reached over here at Zaner, 312-277-0110. Find me on Twitter, Facebook. I'm definitely going to try to be on Sunday night to do a video, latest probably Monday during the day, to recap what we hashed here. Talk about action, like some of the action we could take at that moment in time, because the only reason I'm hesitating giving game plans now is because we don't know if we're going to gap up, gap down, or open at the same price. Depending on what we do and how we trade immediately thereafter changes the game plan dramatically. But moral of the story is, if there is a decent little correction or some dip to buy into early next week for certainly corn and beans, I think it's one that we're going to want to probably take care of. For those producers looking for reownership strategies or something out into new crops still for sales that you're doing at these prices, look at that $8, $10 call spread in the corn. That's a July July and December $8 call, selling the December on December $10 call in corn. Makes for an interesting even money spread there to get a potential $2 futures move out of the market for price appreciation. Have a great day, everybody. We'll be back with you as price action develops. Take care, everyone.